It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners right here on the program. With me in the KFG studios, as always, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
And friends. At what age is the right age to get long-term care insurance? So should you explore long-term care insurance? Are there other options you should consider? And we're going to explore that and more coming up on this hour or half hour of the Wise Money Show.
Is it like daylight savings? I feel like we lost an hour or two of sleep or 3 of sleep last night. I don't know. But hey.
Yeah, the moon was a little strange last night. So,
all right. If you have a question for us, you can engage with the Wise Money Show several different ways. First, if you have any needs, and we're going to talk about one of the biggest financial risks that we all face in our life. If you have any needs, we'd love to help. You can find us online, wisemoneyshow.com. Submit questions for the show there as well. Call or text 574-222-2000. That's 574-222-2000. And then most engagement comes on social media, just wherever you're at. We're there as well. Just search the Wise Money Show, submit questions there, reach out to us there, and we'll connect. All right, so I do think I'm not overselling this. This risk is, I think, one of the biggest financial risks we all face. We've all seen someone in our life, either a family member, close family member, distant relative, something like that, who's needed long-term care in their life. Even though you say it will never happen to me, we all have had family experience, and it's just awful. And the risk is scary because the care can last an undetermined amount of time, and the cost is just outrageous. So the question I want to start with is, at what age, when do you start considering this risk yourself and trying to solve for it and manage it?
And can I answer that question with a question?
No. Yes.
Which was a question. No, I was thinking the question that I'm most curious about is if there are 6 areas of financial planning, and this is a show about financial planning, which areas does this long-term care decision touch? So you have your present financial position, you have protection planning, tax planning, investment planning, retirement planning, and estate planning. So, Josh, if you're looking at these 6 areas, which of these 6 areas does it touch?
Well, I guess if you just went right down that list, present financial position, so long-term care, either paying for the insurance, there's a premium attached to that, you're paying for some protection, that's a cash flow decision. Mm-hmm. Or if you don't, and someday you're just counting on there being enough income to cover your needs if and when you get to that age or that health condition where you need the help, you're just kind of counting on your present financial position to stay strong way out into the future. The second one, that protection planning, clearly this is an issue for protection planning. It's insurance planning, it's risk management. So do you have the right coverages in place? And one of them is long-term care insurance. You planning ahead to have resources available in case you have really what is a catastrophic expense in many people's lives.
Yeah.
So, and we could keep on going down. I mean, there's tax implications of some policies. If you
some policies give you a state tax deduction,
right,
for your premium,
or if you itemize,
yep.
There could be a deduction there too.
Lots of people wonder, hey, should I just, instead of buying insurance, should I self-insure? And can I invest my way there to self-insurance? So investment planning. This, Josh, has been one of the risks that you've said for a long time, that it's a risk that could punch a hole in your retirement boat below the waterline.
That's right.
And so from a retirement standpoint, making sure that you not only carve out how are you going to protect against this risk, but then if this risk occurs, what what is the impact in your retirement plan, and then your estate plan as well, because many people think of Medicaid or the nursing home's going to take all my money or take my assets. So what could I leave to my heirs? And so being planful about that. So Kevin, I took the bait. I think Josh was trying to fast forward it there, but you're man, I'm pumped up. I go from I haven't had enough sleep to I've got way too much energy for this room and this microphone right now, because this long-term care, this one issue touches all 6 areas of your financial life. And we would argue you can't make the best decision. You can't make a great decision about how to handle this risk without looking at all 6 areas of your financial life.
That's exactly right. And that's why it's not any one of those 6 areas. This is a true financial planning issue, right? Yeah. And deciding with your financial advisor, how does this fit in your overall financial plan? Because this is one of those things, it doesn't do anything to really advance the ball down the field. It's not like it helps build wealth or anything, but it does help to preserve it. And that's why it really becomes a multi-generational issue as well. I'm remembering a family that Kevin started working with mom and dad. I've gotten to work with their kids, and one of our other advisors is working with the grandkids.
Love it.
And Kevin, years ago, maybe you can even think about who this might be, but years ago, you helped them make this decision on long-term care insurance. And now they're at the age, I think the husband has passed away, and mom needs long-term care help. She's at a point where she needed to go into an assisted living facility, and it was my client, her son, who's helping kind of make these decisions, helping her manage her financial life and everything, and helping her get settled into this facility that she just absolutely loves. And he was just raving about the power of long-term care insurance, because for them, it took the financial risk and the financial concern off the table, and they could just sit down and talk about, all right, what's going to give mom exactly what she needs as far as care? It became more of a health care and a lifestyle decision as opposed to a financial risk or concern for the family.
I don't want to start here, but I'm going to. That to me is one of the great advantages of proactively protecting against this risk. Is I mean, no one's thrilled to talk about this and make these decisions, but you approach them quicker with a clearer head when you have insurance, versus if you don't, and it's mom and dad's resources, or it's your resources, or it's some sort of Medicaid planning that you're doing, you delay at all costs. Listen, you want to maintain your independence either for yourself or for your parents for as long as possible. You do. But when it comes time to make some tough choices, if you have that insurance in place, you step up to the plate. And if you don't, you typically delay as long as possible. In my experience, we delayed far too long and put family members at risk because of the situation. When I came, I started this. When I came home and a family member was trying to microwave a dinner for my child at 3 p.m. with a fork on it in the microwave, right? You realize, okay, wow, we have gone way past the time to make a decision here. Now, time to make a decision. Let's bring it back to this issue, because we could talk about long-term care for way longer than anyone would want to listen, right? But this is interesting. Would you approach a middle schooler and ask them to start buying and paying for homeowners insurance? And that's almost what you need to do with long-term care, way before you might need to use it, where you almost can't even fathom this risk. You need to start talking about this risk. Well, okay, Mr. Wise Money, when is that? Is that age 65? Is that age 55? Is that age 75? And then, so not only when do you need to consider this risk, when, meaning what circumstances should you absolutely consider this risk, and what circumstances are you self-insured? So we've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Had to monologue it there. Hey, YouTube, thanks for being here. You are at the Wise Money Show. This is the Wise Money Show channel. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel. 10 a.m. Eastern Time every Saturday morning. If you're in the podcast as well because you don't like how we look on video, that's fine. I understand it, actually. So go check that out. It also airs at 10 a.m. every Saturday Eastern Time. If a full 1-hour show is not your bag, that's fine. We've got more palatable 10-minute, 8-minute, 12-minute Next Wise Step videos that air all throughout the work week. So check that out. Make sure you hit that subscribe button, turn on notification, and smash that thumbs up button. And if you are about trying to make wise financial decisions in your life, I'd consider being a subscriber here. Thank you. All right, good. So we're going in segment 2 on the outline, segment 1. That's good, though.
We're ready to get started.
I'll tell you,
Intro's over.
Fantastic.
So I actually just emailed you guys something which will kind of blow your mind. Because when you look at traditional long-term care sales, if you can look at it yourself, but I mean, we went from a high of 700,000 to where we are currently. And last year they sold 49,000.
And let the listener know this is not like a Korhorn Financial Group sales. This is the industry.
No,
how many people?
This is in America, huh?
In America, yeah.
So there's something happening. There is a shift right now happening within our industry. I think, Mike, it might make sense to also just kind of frame the problem. Home care services are $4,500 a month. This is a monthly average nationally. Assisted living's $5,200 and nursing home is $78,900. So eight times 12, it's $96,000 a year for a nursing home. So
say that quick when we get it going. Yeah.
Okay.
All right. Do you need to protect your financial life from the risk of needing assistance or long-term care services at some point in the future? Is it really a big financial risk? And if so, when do you manage it and how do you do so? That's what we're talking about right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media. Engage with us there. Wherever you're at, we are there as well. Search the Wise Money Show and follow us. We are talking about long-term care, the risk of needing care. And we want to start with what age do you start assessing this risk? But why even assess the risk in the first place, Kevin? Like, what's the problem?
Well, when you look at this, the average monthly care cost in 2021 nationwide, $4,500 for home care services per month, $5,200 a month for assisted living, and $7,900 a month for nursing home. So if you round that up, you're basically it's $100,000 a year for a nursing home. And
I would have told. So I just went through this with a family member who we'll talk about it at some point, who passed away last Thanksgiving, and those prices line up with exactly what our experience was, except for the nursing home. The nursing home, I would tell you $9,000, 9 to 10,
and that is actually pretty much right in line with what the average is here in our neck of the woods.
Oh,
in
really?
Indiana, it's just over $9,000.
And guys, do you remember when we were talking about long-term care? It probably was one of the first. We're in our almost our seventh season of Wise Money. One of our first shows about long-term care, we were saying those numbers for these outrageous high cost of living areas like San Francisco. You could spend $10,000 a month on it. And now, just a few years later, that's what it is here in low cost of living Northern Indiana.
Right. Mm-hmm. Right.
So it's a big risk, and that's where Josh says again that if that happens to you financially, that can blow a hole in your retirement boat below the waterline. And so when do you start trying to protect against this, or at least assessing all 6 areas of your financial life to see how you should manage this risk?
I like what you said in the last segment, that you have to think about this long before you're facing it. And you might even be needing to look at it before you're even seeing your parents face it. Mm-hmm. So it just feels even less real when you're thinking about, yeah, man, I might be 90 years old someday. or I might have a decline in my health that requires me to get help with things that I just sort of take for granted. We often, when we're talking about long-term care, the need to get some help with activities of daily living is the phrase that is used in the industry.
Can you say all 6? Do you know them?
Oh, boy.
No, I can't either.
So eating, dressing yourself, bathing, using the restroom, transferring from one position to another, like seated to standing, laying down to seated, that sort of thing. And then continence, so being able to hold it, not going to the bathroom would be the 6th one. And for some people, it's not even an activity of daily living. It's some sort of cognitive impairment where, they don't know to take their medicine at the right time, or they're not sure where they are at times. So,
or hey, it's not okay to put a fork in the microwave, right?
Exactly.
So, okay, so what time? What age? When I started my career, and that was about the time you started your career, Kevin. I'm just kidding. A little bit after Kevin, it was 62. Make a decision by 62, maybe even 65, and then that moved to age 60. At least for me, I'm going to throw it out there. To me, this isn't like a mutual fund rebalance discussion, one and done. This is a couple conversations, and I like to start the conversation by age 55. And I almost wonder if that's too late now. But I would want to start the conversation by 55. You've made a decision by 57, 58.
So if you're answering the question, at what age do I consider long-term care insurance, that question, the answer to that is, I'm going to say that decision needs to be made somewhere between 50 and 55. If you ask the question, how do I plan for a potential long-term care stay? Because a lot of the folks that come and work with us and seek out a financial planner don't even come find us until they're in their 60s. And what do they always say?
Wish I had started earlier.
I wish I'd started earlier.
What's that smell? Answer the question. So answer the question. When do you start planning?
Okay, for the listeners out there, Mike is coaching baseball. He's coaching a bunch of 8-year-olds in baseball.
Jokes.
His dad joke muscle is just grotesque at this moment.
That's right. So answer that question. When do you start planning for this risk?
So the planning, if you come in and say, hey, I want to analyze the 6 areas of my financial life and I want a plan. I want to have a plan. I can't tell you how many professionals we work with that their entire career revolves around a plan. If you're a teacher, you've got a lesson plan. If you're an architect, you've got a plan. If you're a contractor, you have a plan, a blueprint for the house. All these things. So many occupations and folks that we work with, their lives revolve around plans and planning, but they don't have a comprehensive financial plan, and they don't have their financial life all tied together. So if you're making a plan, the long-term care insurance is a possibility. I'm going to say till probably 55, and then beyond 55, why would long-term care insurance not be a possibility? Potentially because you've had your first medical event that says, hey, this event has happened, now I can't get it.
Right.
And so you think, well, what might that be? It's different for long-term care versus life insurance.
I have bad joints. I've been going through the ringer at trying to figure out what's going on with my wrist, what's going on with my hip, what's going on with my brain. And I'm going to say right now, I wouldn't be. I'm done. I won't be able to get it. At 40.
Right. So you're answering a different question. Your question is not, at what age should I buy long-term care insurance, which I can't buy in the first place.
Right.
Your question is, do I impoverish my spouse in the event that I go into a nursing home? And if that's possible, then the plan shifts to, okay, what do I need to do to take care of that? Because a lot of times folks will say, hey, I don't have to worry about that because the state will take care of me. And that is, think Medicaid. So folks always can confuse Medicare, Medicaid. Medicare is a social medicine program for people 65 and older, with a few exceptions to that. Medicaid is health care and other kinds of care for the indigent. So think the social safety net.
Yeah, welfare in a way.
Sure. So if I am completely impoverished, Medicaid will step in and pick up the bill. But my independence is gone. My choice is gone. The possibility of having my own room is gone. I think about that, and I think of my poor roommate that I had in the Army. He was a neat freak, and I'm not. I'm a collector, and so I'm always collecting things. And so,
At what point does it become hoarder?
Yeah.
When have you crossed that line?
A long time ago.
So anyway, in my messiness, I think I would be a horrible roommate, especially in a long-term care facility, especially if I'm cognitively impaired.
If more.
Did you say cognitively?
Okay, so
Very presidential.
But Medicare and Medicaid, just to point out, Medicare does not cover long-term care services. Medicare does not. It might do some rehabilitative work.
First, you think
30 days, maybe
a portion of 100 days in the event that I was in the hospital and I came out, and I mean, you have to hop on one foot, tap your head, and rub your belly.
Medicaid would, but again, qualifying is the big issue. So we're still breaking down when, and then what are your options to plan for this, that and more. Coming up on the Wise Money Show with Korhorn Financial Group. Man, that's good. We got, did I say 4 segments with this show? There's 42.
All right, yeah, which one are we on right now?
We're starting the third. No, I'm focused in. We're starting the third.
But so let's keep answering the question. I mean, the question is, if I want long-term care insurance, I would tell you, look, you either do it before you're 55 or before you leave the state of Indiana. That's what I did. When I was 42, 43, we moved to Michigan, and I bought long-term care insurance before we left, hoping.
Yeah, and I mean, those opportunities to buy it are basically gone now. There's really no carriers that are offering the partnership plan that we can offer anyway. I mean, they're exiting the state rapidly.
Yep.
Who is there one left?
There may be one left. A captive
Bankers.
company. Is it Bankers?
Mm-hmm. Mm-hmm.
Isn't that sad?
Mm-hmm.
Man.
Well, that is the state.
Mm-hmm. That is the risk, you might say. The state has the requirements.
No. I'm saying that's the state of the industry.
Oh, okay. I thought you were saying it's because of Indiana's policies.
No. I'm saying that's kind of that's our current condition, and because the risk is, if you say, well, I can only buy long-term care insurance from one place, and it's Bankers.
It's a place that has a reputation for trying to sell you every stinking insurance policy ever under the sun.
Right. So they may not have the best reputation in the world, but if they're the last man standing, that might be a little bit of a struggle. Mm-hmm. So I might be looking at a hybrid or a plan.
I think we've got 2 more segments with this, but there needs to be some sort of something near the end, or at least be aware that we can't have a cliffhanger at the end of this segment. Sort of.
Right.
Okay. All right. Here we go. If you're considering protecting your financial life against the risk of needing long-term care services, how do you do it? What circumstances do you proactively get some insurance coverage? In what circumstances would you say, nah, you don't need it, you're self-insured? We're talking about that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content and every single show on the YouTube channel. Find us online. Go to YouTube, search Wise Money Show, subscribe to it there, turn on notifications so you're made aware every time we drop a new episode and a new video. Leave comments there as well. We appreciate it. Okay, so Kevin, you're talking about you should be planful, maybe not specifically with this risk, but you should be planful about stewarding your entire financial life and preparing it for the future as soon as you possibly can, right?
Yes,
and
absolutely.
and that process of having an emergency fund in place and paying down debt and saving up early and preparing for retirement, all of those things help you manage this risk way out there in the future, the risk of needing long-term care. And so then you get to your 50s, you're saying, and between 50 and 55, you are working with your certified financial planner. You're probably spending a lot of time on tax planning, proactive tax opportunities. You're spending a lot of time dialing in that retirement plan and that investment plan. You're talking about college planning with your CFP as well. So you've got a lot cooking at this stage of life. And during that time, you're also talking about how do you want to plan for this risk of long-term care. But that's probably the wrong question. It is, let's start the conversation. If you need this care in the future, what does it look like for your financial life?
Yeah, and I'm glad that you use the word conversation, because that's a conversation between you and your spouse. It may also be a conversation with your family, right?
Absolutely.
That seems like an old-fashioned value where family sort of takes care of the older generation as they're aging, as their health fails and everything. But the reality is we might, as a nation, as a society, have to go back to that, because this idea of always being able to delegate it, we talked in the earlier segment about how expensive it is to hire this done. And, a family rallying together is still a way to manage some of the costs and prolong the day when you have to get really skilled nursing care involved and everything.
But I would argue that's not a plan. And we have that conversation. In fact, I think the statistics are close to 50% of folks that need some sort of care receive it from a family member, maybe even more than that. But as I will just tell you, my wife went from working full time to going down to 1 day a week just to keep her job while she cared for her father. And it was not that, like, the burden that it created. And I don't want that to come off sounding the wrong way. But even if you've got a son or daughter or son-in-law, daughter-in-law, or a spouse that it was a nurse or something like that, the studies are quite clear. The toll that it takes on them,
right?
And not only the disruption. You can't take a vacation. You can't usually get a full night's sleep. There's also, you can't work. You'd have to move. You might need to change and refurbish your house. There's lots of challenges, even when you're just.
But I go back to what Josh said, which was a repeat of what you said, which is the conversation. So to me, I'm not saying the family solution is the solution,
right?
But it's in the range of possibilities, and the question is there a room, and are there any kids that might step up to the challenge? The sacrifice that as you were describing it, Mike, the sacrifice is huge, and if you are in the midst of this right now, we have great empathy for you. I have seen it where I have kind of lovingly suggested to folks, hey, it's probably time that you get more help. It's probably time that you get some respite care so you can be gone and if there's a possibility of adult daycare so that you can get a break and run errands on a certain day. But people, the wearing down and wearing out of people is so gradual, they don't really notice it, and it is.
I'm actually watching that right now with my in-laws. They're caring for my wife's grandmother, already cared for another grandmother. She passed away a year ago, and now we're kind of right back into that same situation. But the beautiful thing is there's a kind of a sharing of the responsibility between two siblings who are close by, and grandma is able to spend time in both homes, and she's well cared for. And yes, it is a burden, but it is one that comes with a built-in break this way. Mm-hmm. And not every family can pull something like that off. Right?
That I would say that is that is dreamy.
That's extremely rare. Wonderful that they've got that sort of support system, right?
But that's why you have to have these types of conversations, because mom or grandma in this case, she may have been thinking all along, hey, I've got 3 kids, I'm fine, right? My kids will step up and take care of me. But that doesn't mean that it fits in their life, that they're in a position to be able to do this. And so you don't want to just presume upon family members, but have the conversation. You may have family members that are scattered around the country these days, and so it's not even a possibility for them to come to your rescue.
I look at the way my kids take care of things right now. Heck no. Heck no.
Yeah,
no.
thanks.
Don't let them near me.
Okay, so consider planning for this risk and planning for financial independence from the very beginning, as soon as you get your first job or as soon as possible. Start the conversation between age 50 and 55, and that conversation, when it comes time to manage this risk, self-insure, which your certified financial planner can help crunch some numbers and talk through that with you. And the risk that I tell people when they are self-insured or might be self-insured is, listen, when it's your own money, you will prevent the decision as long as possible, though. Even if you feel you've got ample resources to cover this cost, ample cash flow, it is different. You will delay as long as possible. I've seen it. And so just because you are self-insured doesn't mean you shouldn't even consider the insurance. So then the second is exploring traditional long-term care insurance that serves one purpose and serves it the best way possible, and that is protecting against the long-term care risk. It really provides no other coverage. And so, yes, just like your homeowner's insurance, you might pay this premium and your house might never catch on fire. You might never use it.
And it is an expensive premium too, but it is one of those types of coverage. If you're the one who ends up using it, it ends up paying for itself so rapidly.
Oh, yeah. You could stay 3 months in a nursing home and pay for every penny that you've paid. I mean, the ideal is I pay for this in my own situation. I hope I pay for this for 50 years and die reading the newspaper, if they still have them at that point in time, in my favorite chair.
And then the kind of the third alternative to exploring managing this risk is some sort of hybrid policy, is I think the best way to describe it now, and that is a combination policy offered by an insurance company that manages both the risk of passing away, so life insurance, as well as has some long-term care features, or an insurance company that offers an investment tool designed for income, i.e. an annuity, that has a feature that if you need care, the income gets a boost or the account gets some sort of boost. Those are some big decisions. Those are complicated coverages that if you're not walking with someone who is a fiduciary and helping to steward all 6 areas of your financial life, you could get a recommendation that's very inconsistent to really what you need. So how do you evaluate when and what type of coverage to get? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. I feel like that worked out. There was a cut there that we said it. I just threw it all in there at the end.
Yeah, that's good.
So
all
the
the different
3-segment show.
Tools and products.
But
and
let's pick
everything.
it right back up. Let's keep talking about that. 13 minutes. We got 4-segment land in the plane. So, all right.
Talking more about circumstances to consider.
Sure. So I just threw it all out there. When would you say, I think I might be self-insured? Is that at $5 million, or do you say, no, I'm at $5 million, I still want to protect that?
Hey, what is that?
Upside down coat hanger.
It's a
Hangman.
It's a cliffhanger.
Oh.
Oh wow.
Mike said something about
Yeah.
a cliffhanger. I'm like, what does a cliffhanger look like?
Terrible art and terrible joke. Everything is shameful in that whole situation.
Ah, that's great. And true.
What was the first version there?
I'm trying to. I can't. First of all, I can't.
If you say that was a 7, I'm gonna. No, you were trying.
I can't draw. I don't know how to plan ahead. I have a horrible sense of humor, and I have very encouraging friends who overwhelm me with their positivity.
Hey, will you just entertain us with a drawing of an owl real quick? Oh, please. That's
Just
my favorite.
because I should be in charge of graphics for the entire enterprise, you guys are a little jealous of my skills. It's okay.
So draw an owl. The question is, does the owl have a beak as a nose and then a mouth?
Yes.
Smiley face.
A smiley face? Or
Yes, it does. Thanks for asking.
all right.
Okay.
A innocent mistake. I think any 6-year-old or lower could make that mistake. It's very innocent. I wouldn't know how to, because the owl face it's almost like a person's face. But yes, the nose is the mouth.
Try drawing an owl and just leave it at a beak. You're like,
Yeah, I made a mistake.
nope. This thing needs a mouth too.
All right, here we
Give
go.
him a big smile, big toothy grin, right beneath
funny.
that beak.
All right. Is there a certain type of insurance protection for long-term care that's better than others? That's the right one for you, and the others are bad choices? We're talking about that right now, the circumstances and then how to plan for this long-term care risk. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. If you're into podcasts, the Wise Money Show, every episode's on podcast wherever you listen. Search the Wise Money Show, subscribe to it, and then rate the show. We appreciate that. Okay, so we've been talking about the risk of long-term care, and I got to tell you, I mean, every show is organic. I mean, we know what we're gonna talk about for the most part, but there's no script. We just go, and how we've gone, this show has been a little different than what I expected, but hopefully it's been helpful to you. Let's get into some of the circumstances of when to transfer this risk using insurance, and then what types of tools you should use.
Yeah, and in order to set the table for that, let's talk about the range of possibilities.
Yeah.
So on the far end, you say, "Hey, I do nothing. I ignore it. I'm not worried about it. For whatever reason, I might be self-insured." So I might say, hey, I've got ample resources that my income or my assets can be used. I just have to tell you, when I first started in the business, I would have these people that would say, well, if I ever need long-term care, I told Mabel, just take me out back and shoot me. And you're like, okay, well, that's cool. But guess what? I've also been there when Dad needs long-term care. And you know what they do? Mabel and all the kids gather around and say, we're going to get Dad the best possible care ever, wherever it can be found, and we don't care what it costs.
With tears in their eyes.
Right.
Right.
It's no longer a macho moment.
Right. So it's very interesting. So you say on one end of the spectrum is we do nothing. On the other end of the spectrum, we transfer the risk, and transferring the risk is writing some sort of a check, typically to an insurance company, to get either pure long-term care insurance or some sort of hybrid. And then there's everything in between. But to me, the biggest issue, the biggest planning issue is, what do I do? Is there a risk that I impoverish my spouse? Because you might be in a situation where, like, well, we're already impoverished, so I can't impoverish my spouse anymore. Well, you may be in a situation where Medicaid will then step in and pick up the bill. You've given up choices, freedom, a number of things, but there's at least a base level of social safety net. But I look at that and I say, if you put some sort of either a plan or protection in place, that does give you the freedom to spend more. Because if you don't have it, you need to just keep piling up as much money as you can to pay for your inevitable care that you may or may not need. So this is where, when you look at the range, and I've seen it where, going back to Josh's conversation with the family, I've seen the family member that said, hey, here's what we're going to do. We're going to build a house that has a house for us and the apartment for Mom, all in one. The garage, there's not a step in the garage. It's a gradual slope. The doors are 36 inches wide, so we can get the wheelchair if we ever need that. So I mean, the house is built very thoughtfully to accommodate from wherever Mom is until the end of her life.
Have you ever been in a house that has the extra wide hallways? It's just luxurious.
Yeah.
I just love it. A friend of mine bought a house from someone who had built it for his wife in a wheelchair, and yeah, that it's just, even the stairs, the staircase is wider, so they had the lift.
Oh, yeah, come on.
Oh, I love it. It's just great. I love going over to his house. I don't know why. It just feels like you've got extra room. So I would say income, here's the tricky thing. Income will disqualify you from Medicaid very quickly. Assets will too, but you can spend down assets. Most people think, I'll just give them away. No, it's 5-year look back and all sorts of things. But you can do some sort of creative planning with assets. Oftentimes, it's not easy, a huge sacrifice and all of that. But income, big income, Medicaid isn't even going to be an option for you, right, because you really can't have much income. And so to me, I feel like there's great power in the income as you're looking at this and saying, well, do I need to transfer this risk or not? You've got to really look at your income sources and how much. I would, like today I would say if your household had $15,000 a month, maybe $20,000 a month of income in retirement, you might be self-insured. The problem, though, is if you've got inflation protection on that $15,000 or $20,000, then maybe you're self-insured. But otherwise, the inflation, the cost of this care is accelerating even faster than lumber. Even faster. I'm just kidding. But the inflation for this care is outrageous. And so even if you've got enough insurance today or enough income today that if you're not spending that on Disney or not spending that on lifestyle, if your lifestyle is hanging out at the assisted living, that income could be redirected there. But would that income keep up with inflation?
That's why, I'm sitting here listening to this and the planning aspect is just kind of screaming at me a little bit, because most of the time we approach getting ready for retirement thinking in terms of, man, I'm going to live a long time. I want to be able to spend money and enjoy my retirement and hope for, the sun to be shining, the birds to be chirping, life to be great long into the future. And so the stress test that most people just kind of naturally run is, will my money last as long as I do? And this is kind of, it's adding an extra layer to that planning that needs to be done. And it's, I have enough income to live life and enjoy it, but what if all of a sudden there is this catastrophic expense? Does the plan hold up in that circumstance? Because if all of a sudden, a huge amount of income that you're describing, not many people have that much income.
Right.
But if you do, you may think of yourself as just bulletproof, but the reality is, if all of a sudden you're spending $8, $9, $10,000 a month for care, that starts eating into your lifestyle. It may push you into a situation where you're dipping into resources faster and faster. Mm-hmm. And stress testing that scenario also needs to be built into your retirement plan.
The trick I've got, sorry, Kevin, to cut you off, but just to get this out real quick, I've got a couple that she has Alzheimer's and is in a facility, and they're blessed with a lot of income. They've got about, when you include their required distribution from their IRAs, it's about $14,000 a month, and the cost for her care is $11,000. Mm-hmm. It works for them, though, because he does not have any lifestyle outside of that. And now that's sad, and you might look at that and say, that's what you recommend? No, it is not what I recommend. I'm telling him, try to take a trip, try to do these things, go see your kids, those sorts of things. But he doesn't have much lifestyle. When your spouse, who you've been married to for 50 years, is down the street and doesn't remember your name half the time, it's hard to just go out to Red Lobster. It's hard to go on a vacation.
Yeah. So when I think of planning, if you're in your 40s or 50s right now, or wherever you are age-wise, and you're listening to this and you're saying, I'm never going to buy long-term care insurance or some sort of hybrid solution, then I would be thinking of accumulating assets in non-qualified accounts. Because if I've got $1 million or $2 million all in a 401k or IRA or some sort of qualified money, the ability to plan with that money and maneuver in order to position myself to get some sort of assistance from the government, and again, that we know that's a fallacy, get assistance from your fellow citizens, it's really limited, because I'm talking about then paying the tax, paying the freight on all of those dollars fairly quickly.
Yeah.
And the more rapidly I pay the tax on that, the higher the tax rate's going to be.
So if you're going to self-fund, in other words, you need to have assets positioned in a place where you can access them without getting clobbered by taxes.
Big time.
And you need to have a boatload of money too.
Yep.
And that is the tough thing about, we get to help some clients who are marching into retirement, and they never made the decision to buy long-term care insurance or to plan ahead for this. And so they really do have to kind of hold back resources, because they may need to rapidly spend down a lot of money in the late years of retirement. You just don't know.
Yeah.
You may, as Kevin said, pass away in your favorite easy chair someday and never needed to worry about long-term care. But the reality is you need to plan ahead. You need to preserve assets. And so that means intuitively that you've got to kind of hold back your lifestyle a little bit. Those who instead go into retirement and they already have this game plan in place, they may even have a product like long-term care insurance in place, they can not just spend freely or without a game plan, but it's less of a need for them to hold back some sort of portion of the nest egg that's just earmarked for paying for long-term care, because it's already handled with this policy that they've put in place.
Well, so let's take this down to action items. If you're early in your financial life, early in your adulthood, so you're in your early 20s to you're in your 20s or 30s, what should you be doing really quick? What should you be doing related to this risk?
You should own a disability policy. Because in your 20s and 30s, you're protecting your ability to earn an income. So if something happened to you, your income goes away. So you would protect your ability to replace that. Over time, as you accumulate assets, long-term care really is to protect the assets that you've accumulated.
And you're working on getting a solid financial foundation, paying down debt, having a strong budget and 3 bank account system. All right, so you're
determining where should I be saving and investing and building the assets so that my 60-year-old self is in a great position.
Yep.
40s?
40s, in my opinion, as you're launching kids from the nest and everything, and you're starting to turn your attention to your own retirement readiness, watch out for being called upon to be a care provider. And that is the number one reason for why people enter into retirement earlier than they thought they would. So what if you planned ahead and you prepared yourself to be ready for retirement earlier than you even intend to be retired? Just know that you have the financial resources and the flexibility to maybe be a help to someone else, a family member or a spouse.
In 50s, you need to be having this conversation with your spouse, with your certified financial planner. You need to be talking about this risk, even if that means, hey, listen, I have some preconceived notions here. I do not think we need to transfer this risk. Just talk about it. Have that conversation, because if in your 50s you're not having that conversation, you're making a decision by default. So work with your certified financial planner who's a fiduciary who can help you look at this risk in the context of all 6 areas of your financial life. That is it for us. On behalf of Josh Gregory, Kevin Korhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.